Welcome to the Money and Wealth Show, brought to you this week by American Manganese Incorporated. Here's your host, Sterling Fox.
Welcome to the Money and Wealth Show, where every week we bring you opinions on the economy and the markets. And this week, it is a real pleasure to welcome Danielle Park to the program. Danielle is a portfolio manager, a former lawyer, a financial advisor, and the operator of a terrific website called jugglingdynamite.com. Welcome. It's good to see you.
Thank you, Sterling.
You made a speech recently in Vancouver to the Resources Investment Conference in which you referred to madness and mayhem in 2011. What's that all about?
Well, it's the theme was really one of deja vu because I was speaking at the conference in 2007 when commodity prices were very frothy and equity prices were very frothy and bullish sentiment was off the charts. And I was very pessimistic at that point because I thought that we had gone really too far too fast, way above any sort of rational metric. So fast forward, only 3 years. And sadly, we're sort of back in a similar predicament in our valuation work. It seems that we've really come very far, very fast on a lot of liquidity injection and stimulus and all sorts of things which have really distorted prices again. And so I'm concerned that that is going to be a destabilizing influence in the next year or two.
And it's being reinforced. Frankly, you turn on some of these American networks or even Canadian networks that are all talk and all business and all whatnot, and you get a lot of cheerleaders these days singing the praises of the recovery and this, that, and the other thing. And frankly, I'm not buying it, and I'm wondering how many other people are.
It's interesting, today the World Consumer Optimism Index was released, and there was a little story on it in the Globe and Mail. And it was indicating that there's 14 out of 52 countries surveyed had consumers that were indicating any level of optimism. Only 14 out of 52. So, this is widely prevalent, that the real person on the street is not experiencing the bounce back that capital markets have. And I think that there's some really good reasons for that. Huge unemployment remains a big problem.
Sure.
But also just, general frustration with, I think, seeing so many issues that need capital and can't get them, and a certain elite that has been the benefactor of all this government support and have taken huge profits and taken huge bonuses while the economy is still floundering in a lot of ways.
So what's with all the cheerleading? Now, I'm not a doomer and gloomer, and although we do from time to time have stimulating guests who are quite pessimistic, but I'm a relentless optimist fundamentally, and yet I find it very difficult to get on side with the rah-rah crowd on some of these money shows. I just don't buy it. And I didn't get too badly burned in the crash. I know people who got hit a lot harder than I did, but I'm still really skeptical as a result of that very bad experience. And I don't think I'm alone.
No, I think, we've had a decade of a secular bear where we've lost valuations. Stock prices have declined 50% twice. If history's a guide, we'll get that again in the next 5 years or so. And I think that will be the final blow to confidence in terms of investors being optimistic or having faith in the mantra that they're being sort of told over and over. And the people that are back being optimistic in those shows that you're referring to really are on the sell side. They really are in the business of selling that message because they need people to buy their products or buy into their upside plan.
Sure.
So I think that it's not unusual that tends to be the bias because it's sponsored by companies and financial firms that are in the business of selling us risk. It's just that the average person is still suffering financially and doesn't have a lot of money. As we've mentioned before, the typical person does not have a lot of money in financial assets, and yet that's been the only area of great benefit to all the government intervention in the last couple of years.
For a typical Canadian investor who isn't very deeply invested, as we look into 2011, madness and mayhem notwithstanding, where should we look to make a buck, perhaps secure our lives just a little bit more?
Well, it's a lot more simple than people may think, because high quality Canadian bonds are still a decent pick for capital that needs to be kept safe and generate income. And interestingly, in the last 2 months, prices actually sold off a bit on that side. So we have been able to add some back to portfolios at below par, which is a good strategy. If you get a high quality bond, you can get it a little bit less than it's going to mature for. It's got a defined term to maturity. It's going to pay you interest while you're holding it. That's still a very suitable thing for the bulk of portfolio wealth, frankly. And then on the equity side, I'm not saying that there won't be an opportunity for better valuations or reentry into the equity market. We got it last in the spring of 2009 when things went to decent valuations. Now, very quickly that changed. It was only there for a couple of weeks, really, before the the steroid shot from the Fed and company really boosted prices. But really, we have two possible scenarios in my view. Either we just got the whole cyclical expansion pretty much in the first 19 months of this recovery.
Okay.
So in other words, because of the front loading of the injections of stimulus, we had this big run up. Something we should have got over 4 years, we got in 18 months.
Okay. Yeah.
So either nothing much happens here at all for the next couple of years.
Because too much has happened too quickly already.
Yeah, think about it like, buy a car today, don't pay for 84 months. Mm-hmm. Okay, well, you don't need to buy another car in the next year or the next year. So that stimulus has front-loaded the consumption and leaves a gap after it. And I think that's what we're likely to see. And for asset markets, either we're going to get some correction here, which will bring things back in line with some reality. And that correction could be, something like an interim correction of perhaps 10 to 15%. It could also be something a lot more dramatic. Because sterling, as we've talked about, secular bear markets, the entire expansionary phase is taken back in the contraction. So if that remains the climate we are in, we will very likely revisit the lows that we've seen both in 01-02 and 2008-09. We'll probably see it again. So that's what I'm trying to make the point to people is it's not like all is well and we're back on the Rocky Mountain high. Mm-hmm. We're still on that crazy ride. And now that valuations have gone too far too fast and commodity prices are off the charts again, risk is extremely high.
Our special guest this week on the Money and Wealth Show, portfolio manager Danielle Park from Toronto. And we're back with lots more right after this.
Always consult your investment professional before making any investment decision. You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's Sterling.
Welcome back to the Money and Wealth Show. Our special guest this week is portfolio manager Danielle Park, and you might want to take a moment to check out her website, jugglingdynamite.com, which is also the title of a book you wrote in about, 2005, wasn't it?
Came out in 07, actually.
Oh,
yeah,
okay.
Yeah, started in 05, came out in 07.
You're not a big gold person, despite the fact that we've seen gold and silver and precious metals go through the roof performance-wise and price-wise in 2010. You're just not at all impressed by all of this. Your point usually comes down to, well, you can't buy bread and milk and eggs with gold. And that's where you just bottom out, right?
Well, yes. And if what I try and do is invest. So I need to have a thesis that makes some sense. I need to have some math in the equation. Like I literally have to be able to figure out if I think A plus B equals C. That's how we value things. The problem I have with gold in particular, some of the other precious metals are actually have more utility to them, like silver as an example. But gold in itself is a bastion of great human passion historically. And as that, it becomes less about rational metrics and more about belief. And,
in many cases, the belief in the metal as the ultimate insurance policy. If everything else in the world falls off the edge, I've still got some loot that no one can take away from me.
Right. And I liken it to God. You either believe in God or you don't. And I'm not going to argue with you either way. I just think that it's gold may be useful if you have a collapse of civilization and you can go get a gold bar. But I think that if we had that kind of a collapse of civilization, people would be asking you for vegetables or cans of water more than they'd be asking you for gold bars. So anyway, that type of scenario doesn't make sense to me on a belief basis.
Okay.
And then on a valuation basis, I have no metrics to value what gold should be worth. And I would suggest to you that other people don't either. You know, gold at 1,300, many people will say, well, I wouldn't sell it, okay? If it went to 10,000 next week, would you sell it? Many people would say no. Or they might say, yes, we would, because then we think it would be overvalued. But it's that kind of a belief and feel rather than anything practical and rational that values that particular asset.
Well, you know, fear is a big driver when it comes to people and our money.
Yeah.
And the reason a lot of us hoard gold and silver is because we watch people like Mr. Bernanke in the United States adding zeros to the United States deficit on a daily basis. We watch the euro up and down like a roller coaster, all of these paper currencies the world over, and all of this global uncertainty, and we say to ourselves, you know, I just don't trust any of these people. I'm not in the least bit confident they have even a remote interest in my well-being as part of what they're up to. So I've got to take things into my own hands. Short of gold, what else would I do to insure myself?
Well, I think it goes back to, you know, pay off your house, try and have no debt, try and, have savings, store energy. In other words, really, if you think about it, Sterling, gold, fiat currency, all of it is just energy that we store as humans. And the discipline of it is it's foregoing present consumption for being able to store some energy. So people that have no personal discipline can't set money aside, burn everything in the present, and they never get any energy stored. I think that's what happened to our society and our financial world in the last decade, is that the bubbles created all this aspirational appearance of energy, but actually it was just false. It was just excess and not real discipline or habits that make wealth over time. So if you go back to what needs to happen going forward, we need to just knock off zeros. Frankly, that's what I think it comes down to. Where
Bernanke is adding them almost daily, we need to be reducing them as frequently as we can.
And I think eventually it'll happen. And I think it's happening right now. If I'm following the news trail correctly, you have particularly states which are not allowed to go bankrupt, now doing sort of negotiations behind the scene to have the feds change the legislation so that states can go bankrupt. Municipalities can go bankrupt. Greece and Ireland are looking at ways to cross zeros off. Up until now, there's been the united front of Eurozone saying no one's going to go under, no bondholder will take a hit. It's actually not a possible promise. It's like me promising to pay every debt of everyone in Vancouver. It doesn't actually have any credence to it because I am not big enough to do it. So this is what I think the realization in 2011 is coming around to, is that, gee, if I owe you too much money, we both have a problem. And if you want me to keep consuming, you need to forgive some of that debt. We need to start fresh. And I think that's the kind of climate that we're going into. Originally coming in out of the crisis, people were thinking, well, we'll just bail everyone out, the government will underwrite it. But now we've doubled the balance sheet of debt all around the world, and we still haven't fixed the problem. And we still haven't reignited employment, for example. So until we can get the patient up and walking around, all this life support really isn't getting us anywhere except further in the hole.
And the Governor of the Bank of Canada reminding us again just a couple of days ago, in his words, we are not immune from a fragile global recovery. And he said that several times in recent weeks. Again, as if to remind us that there's not really a lot to get excited about yet. Hold off there.
And this morning, urging businesses to find alternative customers, you know.
In other parts of the world than America.
Than just America.
Right.
So now let's look at that, because that's the classic decoupling hope, right? So we live in a global economy. Everybody talks about that, globalization, how intricated markets are all around the world, trade partners all around the world. And then you get into a scenario where you realize that your main trade partners are not well, are not buying a lot. And so now you don't want to be a globalized economy. Now you would like to have pockets of prosperity. And so for the last couple of years, Asia was the great bastion of hope, right? Because the Chinese, the imbalance of us spending too much meant that they had cash, stored energy aside, because they didn't spend a lot domestically, right? They're more savers, not as much spenders.
Sure.
So the government has a store of energy. So to arrest the global recession and to stop it from hurting their country, they take all their liquidity and pump it into their economy, mostly in capital infusions into the property market. So 60% of GDP in the last couple of years in China has been the government trying to insist on growth by building things, factories and malls and shopping centers where no one actually is really living or using.
But using raw materials from Canada to do the building. Danielle, hold it there for a second. Hold that thought, please. We need to take this break on the Money and Wealth Show.
The Money and Wealth Show is archived online at talkdigitalnetwork.com. You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's Sterling.
Welcome back to the Money and Wealth Show. Our guest this week, portfolio manager and financial advisor Danielle Park from Venable Park Investment Council in Barrie, Ontario. You were talking about China and the just unfettered growth that has taken place in China, a lot of it with raw materials from Canada. Thanks ever so much for buying. But in many cases, they've built things that nobody goes to or uses.
Right. So go back to the example of the car and the don't pay for 84 months. If you've got so much overcapacity built, suddenly it makes no sense to keep building more shopping malls and more cities where no one is. They have now office space built for every man, woman, and child in China today. So at some point, the insane becomes evidently insane. In other words, it's been an unsustainable path. They've been doing it out of desperation to try and keep the economy in the world going. Domestic consumption, by the way, has been falling throughout this period. It is now less than 35% of GDP in China. So they aren't successful so far in getting their own home-based consumers to buy stuff. They're still very much in survival mode in general, where food costs have become a huge problem. Big spike up in food and energy in the last year, thanks to all the liquidity from Bernanke and company, has caused a lot of inflation to the person on the street who can afford it least. These aren't the ones who got the big bonuses and the bailouts. They're people that are generally underemployed and struggling to get by. So spikes in food and energy are a big issue. And so anyway, that's why I'm saying domestic consumption is going to be weakening around the world in certainly countries like Asia.
As will the demand, therefore, for our stuff.
Yes,
resources.
And our own domestic economy is in the same boat, because how did we reignite the Canadian economy in the last couple of years? Partly by selling exports to places like Asia, but also by our fellow Canadians really becoming patriotic and doubling down on debt. And we've seen that. The personal debt to disposable income ratio has gone through the roof.
And that's what I wanted to conclude this conversation with. Again, Mr. Carney, the Governor of the Bank of Canada, continues to repeat this warning. And it's unusual for the Governor of the Bank of Canada to talk to any of us other than a hello there once a year. And here he is on national television time after time after time saying, look, the unrealistic levels of personal and household debts in Canada are crazy. We've got to do something about this. He's doing it so often that I'm starting to feel that we're being set up for something here. What is that?
I think he's trying to be prudent in his leadership. I think that he's had very many examples of how badly it's gone in other places, and how at the end of the day, the blame comes back to rest on the government in power and the Federal Reserve in power. So I think that Carney and company are concerned that Canada sort of escaped a lot of the problems early on in this crisis. But if we get another wave of weakness here, now we can't fall back on domestic consumers to keep spending at the same level, because they're already up to their neck in debt. And I think he's worried about, okay, if we get another patch of weakness, another phase of double dipping in housing, for example, in the United States, which we are having as we speak right now, When that happens and you have further weakness, and now you've got Asia putting on the brakes, where do we go to find demand in the system? And that will become more unemployment. And then, can you afford to be unemployed if you have debt?
We've only got 30 seconds here, but I think he's also inferring that, or I'm inferring that he's suggesting interest rates cannot remain this low. They are definitely going, and the only way they're going is up. Brace yourselves. Do you read that into it as well?
Well, it makes sense. If you're at zero, you're at zero, and
Well, we're at 1%,
Right.
which is still silly.
Right. I don't see it as a near term, because if we're right on the weakness that's materializing in the world for 11, we'll probably not see a need for higher rates on a policy basis for another year or so. But I think you're right. I think they've pushed the teeter-totter down on the rate end so far that everything else is elevated, and one of these days, we're going to have to see some normalization of that.
We'll have a final thought from our special guest, Danielle Park, after this.
The Money and Wealth Show is archived online at talkdigitalnetwork.com. You're watching The Money and Wealth Show, archived online at talkdigitalnetwork.com. Here's Sterling.
And now, with a final thought on this week's show, our special guest, Danielle Park.
I would say for 2011, my message is one of actual hope. It's not doom and gloom. It's just a realization that we haven't cured the problems in the economy yet. We have some more work to do, and we just need to keep plugging away and trying to move towards disclosure, fairness, basic principles of honesty, and I think we'll restore our system again, and we'll have another big period of prosperity ahead.
And paying down personal debt should be priority number one, right?
I think so.
JugglingDynamite.com is Danielle's website. It's a terrific place to visit, and you should do so at least once a week. Thank you so much for visiting us.
My pleasure.
It's good to see you again, and hopefully we'll see you again later in the year.
Thanks very much.
Our thanks also to Fritz and the crew here at Churchill's in the Holiday Inn in North Vancouver for the hospitality. For the Money and Wealth Show, I'm Sterling Fox. See you next time.
The Money and Wealth Show, brought to you this week by American Manganese Incorporated.